It's Wednesday, June 24th. I am Robert Marson at Wall Street Beats, hosting two industry legends, sages, I would say. Bob Morris on energy and Charlie Peabody on financials. And it's a great day to have these gentlemen because there's a lot of action going on in both these sectors with news. Let's start with oil, energy in general, and Bob Morris. Bob, why did I see a six handle on West Texas this morning? And what do you do about it if you own energy stocks?
We dipped below 70. We're right at about $70 a barrel, which is, I'm a little bit surprised we pulled back this much. Is it an overreaction? I don't know. We'll see. All the news, it seems to be positive. Peace for the moment seems to have broken out. And Trump was saying today that on the movement of crude oil or shipments through the Strait of Hormuz, that there will be no fees, no taxes, no charges by Iran. And they're continuing to clear out the strait, and oil seems to be flowing through, and they've given a 60-day license to Iran to sell crude oil. So you pretty much checked all the boxes on what could be positive um, for this deal, in the hope that a deal is ultimately struck with Iran, and positive in the sense of bringing oil prices down. And Trump is being adamant about getting oil prices down. He's already launched an investigation into some of the drillers and service stations, saying that the prices at the pump have not come down quickly enough in tandem with the drop in oil prices, which, that there's always a delay between the drop in the oil price and what you see at the pump. But he's pretty adamant of trying to, really push the oil price down here. And at $70 a barrel, not surprisingly, the oil leverage stocks have pulled back here. Although, like I said the other day or yesterday, I haven't sold anything other than, I think it was 2 weeks ago, swapping some EOG into Expand Energy and EQT. So, and if I look out at the strip a year from now, we're at $67 a barrel on the forward future strip. And, the pre-war level was around $65 a barrel. If you go back to February, the first 2 months of the year, we were hovering around $65 a barrel. And I've said, I believe that going forward, there should be a greater risk premium in the oil price, just for the fact that there's going to be risk to something perhaps going wrong or not going according to plan on hammering out the deal with Iran, and the fact that this all occurred and that Trump's got his finger on the trigger if they don't comply or they don't play along with the game of getting to some sort of deal here. So it's interesting. I'm still not selling any of my energy stocks. C&Q, I still like it here with where the dividend is. What I said yesterday is, if you want to add to any oil name, I would add to Chevron here. I'm already overweight Chevron. If I were to add to it, I'd add it at 165. If we got down to 165 or below on Chevron, that's where I would add further to my position. In the meantime, where I would be looking to put money to work, and I said this yesterday, is on some of the natural gas names. My two favorite being Expand and EQT. And last week I did add a little bit to those names that I already do own. But if overall you say you want to put money to work in energy right here, given where natural gas prices have held in at, and if natural gas prices never ran up and came back down like crude oil did, but some of these names got caught in the downdraft in the overall energy sector with a pullback in oil. So if I'm looking at Expand Energy and EQT down here, that's the first place I would put new money to work in energy today.
Bob, all right, let me push back on the bull case for oil in here. I saw a report today that there was about 3, 4, 5 million barrels a day of demand destruction in China, and I realized, as an energy holder myself, that there was some incremental production that was restarted when oil was $100 a barrel. So, if in a worst case scenario, the oil market stays oversupplied by 3, 4, 5 million barrels a day this year, what do you think happens to the strip? And what happens if the strip turns out to be right for your oil stocks if oil averages $65 for the next 12 months? So let's talk about the macro first and then what it does for the stocks.
Yeah, $65 oil. It's hard to argue that these stocks are cheap at $65 oil. I think they sort of hold steady. There may be a little bit further weakness on the oil levered names if we're at $65 a barrel for a sustained period here. Um, and at the same time, the pushback against the bull case is there's all this talk about AI, and there's a JP Morgan conference going on this week. And yesterday, EOG presented, and the highlight of the conference was them talking about how AI algorithms are helping them continue to improve the efficiency of their drilling, reducing the drilling time, optimizing the spacing efficiency, all that contributing to greater efficiency in producing oil and lowering their break even cost on the price of oil. So, that's, if you want to make a bull case, that's one thing that sort of pushes back on it, is these companies are continuing, in this case, use AI in better technology to continue to push down the break even price on crude oil and continue to improve efficiencies, which for the capital spend obviously is more oil production on the margin. So on the macro side, that 3 to 4 million barrel per day demand destruction in China, I would imagine is going to come back with the lower
Mm-hmm.
oil price. And
Okay.
that, overall, where are we getting incremental oil? Well, we're getting some incremental oil from Venezuela. And if Iran plays ball, then we will see some incremental oil from Iran. So that's sort of hard then. Even if we have a strong economy, if you've got incremental oil from those two places, you're not going to see oil run back to $100 a barrel, or you don't have any strong uh, bull case on oil in those scenarios.
Hey,
And the
Bob,
stocks, if the stocks, how do you think they perform if 65 is sort of what's the market the next 12 months?
They tread water, or maybe a little bit further weakness.
Okay.
You know
hey,
that
Bob.
the other side of it is that pushback on the bull case is that the economics and the returns for these companies continue to improve, and they continue to focus on returning capital to shareholders as opposed to playing more dollars in the ground to grow production.
So that sounds like the market's pricing in around $65 in here. They're sort of fairly priced with not a lot of risk or opportunity in the short run. If
At
65,
$65 on average, yes, I would agree. At 65.
Charlie, you had a question?
Yeah, a couple of things, Bob. Just want to check facts with you. So Venezuela, maybe they can produce another million barrels, but it's going to be years before they get to 3 million. If one, that was one
Correct.
question. Second is, I heard China had purposely reduced, during the war, purposely reduced their purchases to take some pressure off of prices, and they're going to start buying aggressively. How much could they be buying going forward? And then the third thing I heard, and this is just more of a pass along comment, the hedge fund community is definitely short oil, and they've been pressing those shorts into quarter end, so that lower prices ahead, if they're their incremental player there, are probably likely. Any thoughts on
Yes.
those things?
Yeah. On China, remember for the past several years, China's been buying a lot of crude oil, over 1 million barrels a day, to fill their strategic petroleum reserve. And
Yes.
unfortunately, we don't have data on their reserves and how much it is and how much spare capacity they still have to continue to fill. But they certainly probably pulled oil out of some of the reserves to meet some of the demand and backed off on buying oil to fill their reserves over there. So if we're down here back below $70 a barrel, they'll probably resume filling that strategic reserve that they have there, and that demand will come back. And did they pause some of their purchases? Certainly for the filling their reserves, they did. So again, that's part of the reason I think a lot of it, not most of that 3 to 4 million barrels per day you mentioned, if that's the accurate number, does come back at these prices. As far as the hedge funds being short of oil, yes, they are, and they've been right, and they've continued to press that position. And I think that's one of the reasons we pulled back so sharply to 70, which I didn't expect it to pull back to 70. But I think nobody wants to show that they own the commodity itself, crude oil itself here, until everybody concludes that we've reached bottom, and then maybe you see a little bit of a bounce back. But um, yes, there's no question they're pushing their short position here, and they can, given how much we've come back down towards $7 a barrel. I think they're just waiting to see if they can push it further, or where they cover those shorts and move on. But certainly at the same time, they've taken some money off the table to put elsewhere um, in the market here. So we'll see how that plays out. And then I forgot, what was the first
The
question you had?
production
Well, yeah,
capacity.
Venezuela, yeah, they've increased a little bit, but yeah, you're not getting the 3 million barrels per day anytime soon. They're still trying to get agreements or contracts with the Baker Hugheses of the world to come in and the Chevrons and such to do work to start to put the money into the ground to ramp that production up. So you're not going to see even an incremental million barrels a day for some time.
Okay, excellent. To summarize it, oil stocks, natural gas stocks, more opportunity. And the market seems to be pricing in the strip right now as far as the equities are concerned. So you could bank on that from Bob's expertise. And speaking of banks, let's move to Charlie. Charlie, what do you want to talk about in the banking business or financials in general these days?
A lot going on today. And I'll just mention after the close today, you've got two big announcements. The Jefferies reports earnings. Everyone looks to them to see what sort of strength there is in capital markets revenues. Then you also have the annual bank capital stress test results, which will determine how much capital banks can return to shareholders. Obviously, Micron is going to be the major thing that everyone watches, but those two other things are important for my group. And then, this today, Trump is supposed to sign this new housing bill, which is quote unquote going to help spur housing and affordability. And so a lot of the home builders were up big time, 8-10% this morning on that potential signing. So let me talk about those a little more. On Jefferies, all I'm going to say is, the capital markets activities that they're going to show are going to show that equity and M&A is now the primary driver of capital markets revenues. And I just reiterate, when you have that transition from fixed income to equity and M&A, that marks the mature phase of the cycle. And so I'm continue to be of the opinion that capital markets revenues are going to peak this calendar year and decline in next year. So the question becomes, what do you want to pay, for peak revenues? And I'm a seller of Goldman and Morgan Stanley and J.P. Morgan because I don't think they're going to be able to duplicate this year. Second quarter should be phenomenally strong. So that's what Jefferies is going to show you tonight. So that's capital.
Charlie, is there a way to put that into context or perspective? Is it a back to the old high or way above it or a little bit above the peak? Is this like a huge bubble or just a little, old fashioned cyclical peak in this kind of revenue, the M&A and I guess the IPO,
Yeah, it's going to be records on a lot of fronts. So these are the metrics I've written about and talked about. First, the transition from fixed income to equity and M&A says it's a mature phase. That when investment banking revenues grow faster than trading revenues, that's the mature phase. Within investment banking, when M&A exceeds 4 to 5% of GDP or 5 to 6% of global market cap, that's the peak. M&A this year, deal volume should probably be around 6 trillion plus or minus. Global market cap is around 130 trillion, so that's roughly 6 trillion if you go to 4 to 5% of that. Global GDP is 118 trillion. 5 to 6% of that is about 6%. So that says M&A should peak this year. That will be a record. And then when the mega deals start dominating the landscape, mega deals meaning M&A deals over 10 billion. That usually is the peak of the cycle. We'll have over 80 mega deals this year. The last peak was 70 mega deals. And then finally, when you get an IPO frenzy, I'll just remind people, not all bear markets are preceded by IPO frenzies, but all IPO frenzies precede a bear market. And so all the metrics that I look at in capital markets, which are going to be supported by Jefferies results tonight, say this year is the peak. And so
thanks for the granularity on that in context. That really helps me get my head around just saying it's a record. So I appreciate that.
Yeah. Then on the housing front, since we got the numbers, I don't know if you can put up the first slide, Jen, that shows NH. Sorry. All right, let's deal with that. So this is sort of a slide that I produced from a report I wrote Sunday that shows what the expected dividend increases are going to be, and what the share buyback programs are going to be. And this is what banks will announce either Friday night after the close or next Monday, based on the results that the Fed puts out today on the annual bank capital stress tests. So we get these results from the Fed tonight. We as analysts will calculate, what those results mean in terms of capital return, actions. And the banks typically will announce their, expected capital actions Friday after the close or Monday sometime. This year it's a little bit different because the Fed has frozen the stress capital buffer requirements until mid-year of 27. I know this sounds complicated, but basically these annual bank stress tests would determine how much of a stress capital buffer you needed to maintain. And that it either went up or down based on your results of this stress test. And based on whether it went up, you could return more capital to shareholders, or if it went down, you have to hold more capital and return less. So this table is ranked by what I call total adjusted yield. So total adjusted yield means what's your dividend yield and what's the percentage of shares you're going to buy back. So if I got a 4% dividend yield and I'm going to buy back 3% of my shares, I have a 7% total adjusted yield. Some people believe that a higher total adjusted yield means a better outperformance over the next 12 months. I've not seen, definitive data that supports that, quite honestly. So I'm a little bit skeptical about it. But this is, what people look for is total adjusted yield. And you can see my one high-rated name, M&T Bank, is literally at the top of this list in terms of total adjusted yield. So that table I'll reproduce at some point for you guys, but that's what comes out tonight, and will have an impact on how some of these stocks trade tomorrow. The next slide, Jen, if we can go to this is the NAHB home builder consumer sentiment. So now I'm shifting over to housing. So this NAHB home builder sentiment index is near historical lows. The index is at 35. Typically, when you get into the 30s, that's a recession in housing from a home builder perspective. And some of the findings of the home builders, this came out just earlier this week, was that 35% of builders had to cut prices in June. That was up from 32% in order to move product. The second was there was an average price reduction in homes sold by home builders of 6%. That was literally unchanged from the previous month. And that home builders had, 62% of home builders had to use incentives like mortgage buy downs to move product. And that was up from 61% in May. And that's the 15th consecutive month that, incentives, over 60% of home builders had to use incentives to move product. So it's not a good report in terms of sentiment from home builders. Today we got housing new home sales. I don't know if you can put up that. These are the salmon colored columns. And the only thing I can tell you, because it's probably hard to read, is that the new home sales that came out today were very disappointing. They came out at 580,000 new home sales in the month of May, and they were supposed to be over 600,000. New home sales as a percentage of total sales in this month was down to 12%. They've been running around 14, 15%. So home builders are having a tough time. Now, that
Charlie,
said, go ahead.
Can you talk about the existing home sales and just what's happening in the market? I know some cities are sort of in double-digit declines, but Case-Shiller seems to be holding up. Do you mind opining on what you think's happening in the existing home sale market, the housing market in general?
Yeah, I mean, existing home sales have been running around 4 million plus or minus, which again is a depressed rate. Usually 6 million is considered healthy. Mm-hmm. It's been, that 4 million plus or minus for about 3 years now. So there really, there's been a slight pickup recently, but, still not substantially above the 4 million run rate. Supply of existing homes is 4.5 months of supply. the pending, which again is low. I mean, usually you want a 6 month supply
Mm-hmm.
of homes. So that's helping hold up prices, but it is a buyer's market, not a seller's market.
Mm-hmm.
Now,
Mm-hmm.
again, I still think home prices can come down by 15 to 25% nationally on average, but it's going to be in pockets. It's going to be, weakness in St. Petersburg, Florida, and Austin, Texas, and strength in Cleveland, Ohio, and Boston, Massachusetts. So
Mm-hmm.
it's not going to be like we saw in 2008, where it's universally weak. Um, the pending home sales index did rise last month to 76.8. That's a forward-looking indicator that says new home sales should pick up. But the home builders, today's report showed that they still had 10.3 months of supply, which versus a 6 month normal. So
Yeah.
that's very unhealthy, and it's why they're still having to, add incentives to move product. So today you'll see the home builders, particularly the entry level home builders like Pulte and Hovnanian, LGI Homes. They're doing very well because the Congress yesterday passed a Housing Affordability Act, and Trump's going to sign that today, and that is intended to improve, home sales, particularly at the entry level. I don't think it's going to have an immediate impact. It may have an impact a year or so out. So I think whatever rally we have in home builders in the short run is probably going to fizzle out by the end of the year. So I'm not going to chase these names
Oh,
in March.
there's been a dearth of starter home building now for a decade at least, as everybody's moved up market because they figured they can make a lot more money, right? So it's kind of an unmet need right now, but they don't get rich. Toll Brothers doesn't get rich building starter homes, right?
No, and Toll Brothers has had better results than others because they're the high end. So everything that was passed in this bill yesterday is geared towards the low end. So we'll see if that helps. But the things that were voted on and passed are multi-year in nature. They're not going to transform housing overnight. So.
Okay.
I mean, if you want to play a recovering housing, I would prefer things like Sherman-Williams or Mohawk or Masco, Builders First Source, the ancillary plays, because they're not seeing the same margin pressures that the home builders are.
I'm more interested in shorting the rally.
Yeah, I mean that's my position. I don't think there's a bottom in these home builder stocks until next spring at the earliest. But you do get these interim rallies that get people excited. So
Yeah. Okay. Anything else?
if there is, I've forgotten it.
All right. Well, I could tell you that I bought I am in Financial Stocks Anonymous, that 800 number that whenever I think about buying a financial stock, I call it and they talk me down. So I called it and they couldn't talk me down yesterday. So I bought a PayPal at 41 and change. And it's, a payment system, obviously a fintech company, not a bank, even though they're going to get a bank, I hear. But I think the stock was a couple hundred, 300, not too long, a few years ago, and it's down to 40, and it's eight times
I
seven,
actually
7 times earnings, and they're buying back 8% of their stock, and they had mid-single digit revenue growth. So I'm in this revenue per share kick. So if I can get double digits revenue per share growth organically from buybacks and organic revenue growth, I could buy something that's down 80% from its high and dirt cheap and has a mid-teen free cash flow yield, net cash on the balance sheet. I'm willing to, take a flyer. So it's a starter position. If it goes up 10 baggers, it's not going to change my lifestyle, but I may build on it if I get more comfortable. So
Robert, I actually do own it as well at 44 and change is my average price. I bought it because they have publicly acknowledged that after their recent failures that they are exploring strategic alternatives, and the banking system has made payment systems a priority, and I think somebody in the banking system is going to look at this as a opportunity to beef up their payment capabilities.
I think it'd be a great fit for J.P. Morgan, the best bank in the
Well,
world.
you picked out the name that I'm sort of relying on, because they've got so much excess capital that this would
Yep.
be a drop in the bucket for them to do.
Yep. Okay. And after the close, Micron reports. It's I bought some puts on the Qs to hedge my semiconductors just in case they disappoint. But the street has finally gotten the numbers. I think the revenue growth is triple forecasted versus the year ago. So there's a big increase in revenue. If you haven't looked at a price chart of DRAM and NAND flash, they've both gone up between 5 and 7 times in the last year due to data center demand. So it's kind of hard to not beat and raise when you get a 500 or 600% price increase. I've been doing this business since 1982, gentlemen, and I haven't seen many companies get a 600% price increase on a year-over-year basis for their products. So I do not know if the street is fully caught up, but they're a lot closer to catching up to reality than they've ever been, and we'll see how the street reacts to not only the number but the guide, because the next quarter outlook is for very aggressive sequential growth as well. But that's going to drive, that report will drive the memory trade and the semiconductor trade and the technology trade tomorrow for sure. So something to pay attention to.
Bob, I'm not a well-informed tech investor, but some people are sort of making the analogy that tonight's Micron is equivalent to Cisco's 2000 report, which I think put in the peak of the market, if I remember correctly.
Yes.
2000.
Yes. Well, we don't know. Only if it's bad, right? Only if it's the peak. So that's why the guide will be important. And again, when the commodity price is up so much, there's definitely very high expectations for a Micron report since the spike in memory prices has happened. So the street may have caught up with it, and the stock market may be disappointed, even if it's good news tomorrow. We're definitely at risk for that. All right. Well, I think that covers everything for today. Our 30 minutes is up. Gentlemen, thank you very much for your expertise. And until tomorrow on Wall Street Beats, have a good trading day.
Thanks, Robert. Thanks, Bob.
Thanks, Robert. Thank you.
Yep.
Thanks, guys.